Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Welcome, everybody. Happy Thursday. I'm pleased, as always, to be joined by my partner, Bryan Bibbo here. I got this big, long bio for Bryan, but I don't think I need to read it. I'm pretty sure everyone certainly knows Bryan by this point. He's such a contributor to the organization, such a great advisor. And so, Bryan, why don't we just jump right on into it, unless you want me to spend the next 3 minutes reading this bio for you?
Nah, let's go with it, Dave. People want to hear about me. They want to hear about the knowledge that we have and what we can share to make their practices better.
That's right. That's right. So, topic today, the disappearing 401k match. Henry's retirement planning and a new benefit, and Henry stands for high earner, not rich yet. So these are sometimes opportunities that we bring on. Obviously, I think for most of us, our goal is to work with clients that are rich already, or that have substantial assets. But Henry's can present a really unique planning opportunity that could bring future lifetime value to a firm. And so, Bryan, when a company starts to reduce or remove 401k match, what are the first things that advisors should think about kind of auditing with these clients and their plan? And really, when you see this happening, which I guess I was just chatting with our marketing team, it seems like this is a topic that's trending right now, that companies are starting to maybe take the hatchet to some of these things. But what are you coming across?
Yeah, Dave. Actually, I've ran across this a few times within the last 6 months already on these high earners, not rich yet. But I want to share with you is like the first diagnostic we need to think of is just the overall savings rate for these individuals, right? While they may be losing the matching on the 401k, or we'll talk about maybe later about some of the substitutes and employers are putting in place, we as financial advisors need to get kind of our auditing mind out of like, is that savings rate still going to be on track? Are they still going to hit those long-term goals? And then is there any way we can redirect some funds somewhere else that maybe they have extra discretionary expenses? Having that conversation super important. Like a real life example was I had a 46-year-old, maybe 47 years of age, and the 401k provider and the employer said no more matches because the company's going through some unstable times, right? Usually they cut the employee benefits when that happens. So what we looked at was their total compensation and why they were losing a 3% match. If they put in 5%, we were able to talk about, did they have some discretionary cash that we could put somewhere else? That helped fill some of that void. And then for people that it's very tight on, in those cases, I say, why don't we do this? Why don't we set up automatic increases on your contributions to your 401k? If we do that every January, like increase it by 1%, 1.5%, you're not really going to notice it year over year in your paycheck as much, instead of all of a sudden saying, hey, we got to take 3 or 4% out of your paycheck to make up for that match. So those are the kind of things that I've been working with in the cases that I've had where I've ran across this. It's just we need to be able to pivot as advisors and look at the overall savings rate and still that we're on path. Like in eMoney, Dave, the financial planning software that we use, when you change that rate, it greatly changes the projections for the future. So you got to make sure the client is kept abreast of that and like, hey, what can you do now and in small steps to make that work?
What I, tend to have conversations with them about around the 401k is, how quickly and how early can we get the funds in? Some of these clients that have, pretty substantial incomes, they could max out their 401k by January or February. And there's a benefit of doing that, right? The kind of time value of money, getting money invested, getting it growing quicker. But what I see, time and time again is that sometimes companies don't have what's known as a true up provision in their company match, where, for some of these really high income earners that end up maxing out their 401k in maybe the first few months of the year, their company has more of like a elongated match program throughout the year, and they might be missing out. And some plan provisions have what's known as an automatic true up, where others, they're just out the money. I remember seeing this for the first time like 6 or 7 years ago. I have some clients at Apple, and Apple actually developed a software that like would tell the employee if they were going to miss out on some of the employer match because maybe they had front loaded all of their contributions. And so one of the things just from a practical standpoint that, we do on a pretty frequent basis, especially this time of year, I mean, we've been doing it for the last 30 to 45 days, is we've been requesting a pay stub from all of our high income clients. And we do this for two reasons. Number one, we built out kind of an Excel workbook that we could annualize, take the numbers from their pay stub, annualize their earnings, annualize their withholdings, make sure they're on track to not have a large tax surprise come April. But it also gives us a chance to review their deductions. Have they maxed out their 401k? Have they, made sure that they've done the mega backdoor Roth 401k properly? Have they maxed out their health savings account? All of those things are right on the pay stub. And I know about a week ago, Holistiplan just actually launched an annualizer. The stuff we were doing manually in Excel files, they just added to their software, which is really great too, because that's such a good roadmap to make sure our clients are on track with all of these things.
Yeah. I think you're spot on, Dave. In the world of AI and these softwares and how they're changing things, how we did business a year ago has greatly changed to how we're doing business now.
100%. And the other thing, Bryan, like when we think of, some of the plan design changes we're seeing employers make, there's all kinds of resources a lot of our clients have available to them. There's profit sharing, there's non-elective contributions, student loan matching, HSAs, ESPP plans, deferred compensation. And the big one is like, I have a lot of clients that maybe have a main W-2, but they also have a side hustle, whether that's a Schedule C business that they're making some self-employment income from, or potentially it's grown big enough that we even set up an S corporation there. And of course, in those cases, we're looking at how they can potentially leverage things like SEP IRAs or solo 401ks on top of that. I mean, we just finished a plan for a client yesterday that they have a main W-2 job. So the husband is maxing out his 401k and getting company match there, but he has another side business that's actually, it made over 7 figures this year in income. And so we have the wife on payroll there. She's able to max out the employee contributions to the solo 401k. That's $23,500. We're paying her a minimum kind of reasonable compensation so that we're able to do some employer contributions into the 401k. But then we're maxing his wages so that we can max out the qualified business income deduction, but also dump $70,000 into his solo 401k. So between all of those things, we're able to get, well over 6 figures into the 401k and, really, really strategic planning opportunities. When I broke down the tax savings for him yesterday, just by initiating this plan, it saved him almost $62,000 in income taxes. And, that's, I don't know about all of you, but that's meaningful money to me. That's a big deal. So there's so many things. I mean, Bryan, talk about, kind of some of these different tools that you're talking about with these higher income clients. And they don't, just have to be younger clients. They could be high income earners that are 2, 3, 4 years away from retirement. They're just still working and they have a lot of these workplace benefits available to them.
Yeah, David, let's touch on some of the ones that you brought up a minute ago and kind of talk about like the hierarchy and maybe some of the constraints to some of these things and what we should be helping people with. You discussed kind of the profit sharing, and the main thing with that is we got to realize, hey, it's discretionary. It's great when it hits, but sometimes not as reliable for planning. Like I met with an individual yesterday. Last year, he got $79,000 into his profit sharing. This year, he's getting 16 grand. So you can just see the fluctuations on that profit sharing. So every year we have to sit down, how much went in, how much can we expect? You also talked about one that came to us on the Secure Act 2.0, which is that student loan matching program. And not many employers are doing this, but I am seeing this on the medical side of things for the doctors and everything else, that it's allowing that if they're paying on their student loans, the employer as an incentive plan is going to match some of those payments they're making on the student loans. So just knowing that and being aware of that, that's like something no one ever talks about. Does your employer offer something like that? And that's for more of our younger generation Henrys and those people. So I use the example, the doctors of the world, 30 to 35-year-olds that just got out of med school, have these huge balances. And places like the Cleveland Clinic or University Hospitals that's near to our office are starting to offer these student loan matching programs that can kind of shift some contributions. One major one that I do personally, and I encourage everyone to do that's eligible for it, is the HSA and maxing that out, right? We all know this as advisors, but it's such a good thing. And when you know it's such a good thing, we all stop doing it. We still stop telling our clients about it. So every year maxing out that HSA, but paying your medical expenses out of your pocket, right? So every year what I'm doing, and I encourage the clients to do, is let's max out your HSA, whether it be an individual or a family plan. And then you're going to pay any out of medical expenses out of pocket and don't pay it out of the HSA. It allows that to grow tax deferred. And at a later date, 20 years down the line, hold on to those medical bills and you get reimbursed all in one time. I've helped people retire at 60 to 62 years of age because they had hundreds of thousands of dollars in HSA balances, and we were able to pull that out and get reimbursed for all the health care that they ran into in other years.
And that's huge, even for your retiree clients. I have a client that at this point, she's 73, her and her husband. They have just north of $300,000 in their HSA, continuing to compound and grow. And I mean, just think of, this year, markets are up, what, 17, 18%, 16% in a diversified equity portfolio. So she just compounded at 16, 17, 18% for the year. And we're not taking any money out of there. Now, the one conversation I have with her every year is, I'm always asking how she's feeling, because we want to get all of that money out of that HSA before she passes away. Because if she passes away and it's left to the kids, it's all taxable. But that's where, I use the term and I tell clients it's a bit morbid, but it's where we need to do some deathbed planning. I want to keep it in that HSA for as long as possible to keep this compounding tax-free growth. And I'm having her save all of her receipts, Medicare premiums, long-term care, anything that's eligible for reimbursement under the HSA guidelines. And, we probably have hundreds of thousands of dollars of receipts right now. And at some point, we'll just reach in and take a big lump sum out of that HSA. But for now, I want to have it all continue to compound tax-free.
Dave, I knew you were a great financial advisor, but I didn't know you were predicting deaths and having people pull their HSA balances out the day before.
Not the day before. I always ask them how they're feeling. So I just want to make sure I tell them, just don't give me at least a couple weeks before you die. So yeah, I think those are all good. I mean, just, lastly, Bryan, you touched on, just different employer benefits, which I think is huge to be able to do an audit for these clients and make sure they're taking advantage of everything. I mean, I'm sure you all see it as much as I do, but there's so many employees that are missing opportunities. Whether it's an HSA plan and maybe they're enrolled in a lower deductible plan because they don't really understand all of the benefits of having an HSA and going to a lower deductible plan. Maybe that big deductible scares them away from going to the high deductible plan and being able to max out an HSA. A lot of times they have an ESPP plan available, an employee stock purchase plan, if they're working for a public company. This is another source of free money. I mean, if I can buy my company stock at a 15% discount, and as soon as it hits my account, I can go sell it, that's free money, essentially. Again, if they hold it for at least a couple years, then it's long-term capital gain. But again, that's another big benefit. Obviously, the 401k, the 401k match, the backdoor, the mega backdoor Roth, that opportunity. Deferred compensation is another one. I have a lot of clients. Once clients typically, they're working for a bigger company, it's kind of one of the secrets in the company. If they get to a certain level, sometimes they unlock the ability to partake in a deferred compensation plan. I know, clients at Apple, when they reach a more senior level, they can do that. And when, we look at those clients, what we typically do is take and build out a tax projection, again, in Holista plan, and we look at what marginal rate their top dollars are going into right now. And so, let's say I have a client who is making a few $100,000 and their top dollars are flowing into the 32% marginal bracket. But I know when they retire in a few years, they're going to probably be more like in the 22 or 24% bracket. A lot of times what I'm doing is I'm figuring out the amount of money that's flowing over and into that 32% bracket. And that's how much we're deferring in compensation. I don't want to defer in the 24% bracket, but I do want to defer in that 32% bracket. And so, think about it similarly to how we think about bracket bumping Roth conversions. That deferred comp is a way to get money out of those top brackets. And then, a lot of times you have to elect whether when you retire, you want a lump sum or a, 1 year, 3 year, 5 year, 10-year payout. That type of advice to those clients when you're building out, what their savings and accumulation plan, and then how that translates into their distribution plan is really, really powerful.
Yeah, Dave, you said something awesome, and I just want to repeat it, and I want to give some real life example. Is auditing and understanding the employee benefits that your clients have. I was meeting with a guy yesterday, Charlie. He works for a company, publicly traded international paper. And he was talking about a few things. He's been a client for 5 years now. And before the meeting, I'm smart enough to know, let me pull up the stuff he sent me before. So he is in ESSP plan, RSUs, a 401k, and deferred compensation. And he starts asking me the questions, and I know all the answers to his questions because guess what? I studied them quickly before. I've talked about it with him. He's like, do I need to do the deferred comp this year, Brian? I'm getting a $100,000 raise. And, I just went over all those details with him. And knowing all of that, Joe Volan was on the meeting with me, another advisor, and Charlie's held a Vanguard account away from me. That's 600 grand. We have about 600 of his money. And I was able to answer all these questions. And I said to him, I said, hey, Charlie, doesn't it feel good that you work with advisors that know what you have going on in your employer plan, and then also looking at the investments? He's like, yeah, it's great. I said, this is why your life is so busy now. You're getting that raise. You're taking on more stuff where we can do you a lot of service by managing this Vanguard account and you rolling it over here. And I said that to him. He goes, Joe, are you taking notes? And he goes, what do you mean? He goes, Brian is such a great salesman. And this morning he emailed me over his statements for him and his wife that are at Vanguard. And we're rolling those over now. So I'm going to get some 600 grand that I didn't expect before year's end, which is awesome. But because I knew all of the ESPP, the RSUs, the 401k. So when they send you those documents or you ask for them, knowing that stuff and just looking at it before the meeting. Another way, that I want to just talk about a few different things that we forget about as advisors. It was so awesome to hear about the mega backdoor Roth conversion that was offered, and we all hyped it up, but we forget about it. Like, I've seen so many advisors forget about the mega backdoor Roth conversion. Having that conversation again, even if you need to write it on top of your fact finder when you're meeting with someone that's still employed, that's going to be crucial because I believe that one is forgotten greatly. And we're doing a lot of that business this time of year where we're rolling that money into a Roth right now. We're getting on the phone with a lot of our clients. So I want to make sure that, we're not missing it. The other one, RSUs. I have clients that work at Pfizer Pharmaceuticals. And if anybody knows, if you've had a 10-year with Pfizer, the stock has not done so well. I just rolled over all of their vested balances of their RSUs at Pfizer. So it was vested, it was in a brokerage account, And I was able to move that over into a managed account, and they actually incurred a $68,000 tax loss because of that. So I did tax loss harvesting with their RSUs. Another case at CVS, the stock has somewhat gone up. I had to roll that over, and we'll do tax harvesting over time for the client. So there's a lot of opportunities that are out there within these employer plans, just thinking outside the box a little bit. Dave, and I want to go over a great example that you'll help me with. High net worth individual, high earner, making 500, 600,000 a year out of Columbus, Ohio, client of mine, and he had some discretionary dollars, right? So we threw it into a brokerage account, and we put it into the SMA strategy, and it has grown greatly over the last 4 years. And also, we had some tax losses. So if you can speak to that, like with these people that have this discretionary accounts that they can access before 59 and a half.
Yeah, I mean, I think, most people have heard me talk about the power of these SMAs. I think, they're great if you're just putting a lump sum in or doing a tax transition, but, really what juices them up is adding cash. So when you find clients that can contribute on a monthly basis, think about fundamentally what you're doing when you're adding cash to a brokerage account like this. Every time you add cash, that cash is getting deployed and it's buying stocks. That's creating a stepped up or a higher basis in the stock. And we all know markets are volatile. So if every month we're creating lots that have a high basis, we know there's going to be fluctuation and they're going to, potentially create deduction opportunities. I mean, yeah, I try to encourage highly all of our clients that are partaking in these SMAs to add whatever they can. If it's $500 a month, if it's $1,000 a month, sometimes we have clients like me, myself, I have my money go in twice a month on the 15th and the 30th, just like clockwork. And again, that gives me buying opportunities. That's always creating a higher stepped up basis for deduction opportunities. I mean, some of my biggest clients, one gives us $50,000 a week to go in. We have another one that typically gives us $1.5 million to $2 million a month that goes in. Think about the deductions that creates when you get volatility. So those are huge. I also, I know we have a couple minutes left. I want to go back to the RSU topic because I've been working with RSUs. Essentially, Facebook was the first company that pretty much invented and kind of pioneered the RSUs. So I've had kind of an early track to planning around RSUs. I'll tell you one thing that almost no advisors talk about when I think of RSU hacks is the actual tax withholding on these things. This is pretty unique if you ever run into somebody with RSUs. The federal statutory withholding rate for restricted stock units is 22%. That means if your clients have $100,000 of RSUs that vest, their payroll system is going to automatically sell $22,000 worth of stock to cover the taxes. Now, if that client makes over $1 million, the statutory rate is 37%. So if your client has $100,000 of stock vest and they're over $1 million of income, they're going to essentially sell $37,000 of stock to cover the tax withholding. And the remaining portion, call it $63,000, is going to settle in their RSU brokerage account. Again, I'm going to go back to the statutory withholding of 22% because that covers most people if they're not making over $1 million. If their stock vests $100,000, $22,000 is sold and sent to the IRS to cover taxes, which means now they have $78,000 worth of shares in their account that they have. So one of the things, well, two things. Number one is if that client is actually in the 35% tax bracket, they have a 13% deficiency in under withholding. This is where we do a lot of quarterly tax planning analysis for these clients to make sure that they're on track to make estimated payments or increase their withholdings on the RSUs. But I'll always ask the client, like, are you bullish on your company stock? Because if you're bullish on it, we might actually want to minimize the withholding rate on your RSUs and will pay estimated taxes out of cash that you have elsewhere. Because if I minimize your withholding rate on RSUs, let's say I minimize it to 0, and now you have 100,000 of stock vest, you now have 100,000 of that of shares, worth of that stock in your account. If maybe you're not bullish on the stock, I have a Pfizer client as well, to Bryan's standpoint. He's like, no, it's been a dog, basically. In that case, we might want to increase the withholding rate because now we're liquidating more shares to cover the tax, and we don't have to figure out how to get other cash out of pocket to cover. So playing around with that withholding rate is really important. I have a lot of clients in tech, as most people know, and if they're really bullish on their company stock, we might want to lower their withholding rates because that allows them to accumulate more shares. And the reason that's important is most of these clients can't go to the open market and just buy stock. They're all on restricted insider trading policies, and they have open trading windows. And so we could kind of manipulate the system through withholdings a little bit. And again, this is all stuff that nobody is talking to these clients about. Advisors aren't, their HR departments certainly aren't. And it could be, the difference of winning a large client or in impressing them and showing them how you're different. So.
Yeah, Dave, and you know how we got here was talking about like the 401k and the match going away, but there's so many other opportunities that we're seeing if that 401k match does go away, just auditing the clients' plans and seeing what is out there for them. I mean, we bring up some great ideas that we both have real life scenarios and cases that we worked on.
Awesome. Well, I know there are some questions, Kevin. I appreciate you adding about Holistic Plan, their new income analyzer section. That's the one that I was referring to. And, Charlie, kind of great point on, when you're getting company benefits, save them in your file. Because if you get one company that works for, Apple, obviously most of those benefits are going to be relevant for any client there. And you could use it as an incredible marketing opportunity to expand your knowledge within that employer. So thanks so much, everybody. Bryan, appreciate your insight as always. And we'll see everyone next week.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.